the taxes you owe on your non-qualified investments. To me, I don't feel badly about this because I think it's a wonderful thing to have in your portfolio, but we are adamant in this podcast about talking about other ways to take advantage of money you have sitting on the sidelines. We've talked about the goal of having most of your savings in a high yield savings account, so you're getting a better rate of return than your local savings. We've talked about non-qualified brokerage accounts and the benefits of having that shell of an investment inside which you can place investments of your choosing that have more liquidity than what you find with your retirement account. However, you may be unaware that that interest that you earn from that high yield savings account that you just opened is interest income or investment income that is taxed at ordinary income rates. So when we talk about federal and state income tax, it is just like you earn that money in salary and you have to pay taxes as such. When you have things like your non-qualified brokerage account, you could have dividends, excess profit that is distributed by the manager of your mutual fund or index fund, or the one that is often the thing that trips people up. You could have capital gains even if your investment lost money. And this is really, really frustrating for people who have experienced this, but I'll use a mutual fund as an example. When you have a mutual fund, it is a collection of stocks and bonds that is managed by an entity. And that basket of funds is something that you can invest in with a pool of other investors. So if I'm investing in this mutual fund that has 100 different stocks and bonds, I'm putting my money in alongside the thousands or tens of thousands of other people who have invested in that fund. And that fund predated me, right? They didn't create it just for me. And as a result, there are stocks and bonds that have been in that portfolio for a long time and may have experienced gains, even though I didn't get to participate in those gains. So I now buy into this mutual fund, and let's say that they have a position with Nike that has been a big gain for them over the years, and they decide for whatever reason to sell all or a portion of their holdings in Nike inside of that fund. And they're going to distribute those gains to their investors. So if you bought into that portfolio, a portion of that gain from the Nike sale is going to be assessed and attributed to your tax return. So even if you bought in and you didn't get to ride the ride of watching your investment in that mutual fund go from 10,000 to 15,000, when you get your tax document, there's going to be a capital gain on there from the sale of that position. And it's going to be there even if your actual investment went from $10,000 to $8,000. But this is a part of what it means to have a non-qualified investment that is taxable from year to year. So you have to have an understanding of what that looks like and also build it into your strategy, because if you're a high income investor who's not trying to have a whole lot of gains in your portfolio, that can actually shape the type of investments in which you invest, which is why you see people who have large amounts of income and assets start to shift in many cases to an index-centric portfolio or a single stock portfolio where it's either an entity that doesn't typically kick off as much gains, or in the example of single stocks, you have more control over when you buy and sell for a gain. And as a result, hopefully have a bit more predictability in terms of how it impacts your tax return. And before we hop off that topic, just like for high income earners, there is an additional Medicare surcharge that they pay for income above certain levels. For high income earners, there's also an additional tax on investment income of which they need to be aware. It's called the net investment income tax, and it's applied to the lesser of the actual investment income that you received or the amounts above certain income levels. So we're not going to get too deep into the calculation, but that tax rate is 3.8%. So in our example, if you're subject to net investment income tax, you may have an account that lost value, still have to pay 15% in capital gains tax from a distributed profit, and then have to pay an additional 3.8% on top of that in net investment income tax. These are the reasons why the more complex your strategy becomes and your holdings become, you need to have an interplay between your goals, a financial professional, and a tax professional to make sure you're prepared.